Now let's invite our Alpha manager, Tahir Badshah, now joins us, Chief Investment Officer Equities at Invesco Mutual Fund. Tahir, hi, good afternoon. You know, as a fund manager who saw great 2017, market surging, NAVs going up 50-60%. 2018, of course, I mean, you've seen many market cycles, but 2018 has been a year of some bit of reality check and mean reversion. How are you approaching the market right now?
So, like as you mentioned, 2018 is in our view also not likely to be a very easy year. It's clearly a year in which we have to brace for probably a relatively more moderate returns as compared to what we have seen in the last 2 years. It'll also probably be a year of a decent amount of volatility, and we are seeing that as well. And I think it'll continue simply because of the fact that not just in India, but even globally, there'll continue to be this debate on whether growth is higher than expected or inflation and interest rate challenges are going to be more than expected. And I think that is going to induce a decent amount of volatility along with other factors like US-China trade related issues, or it could even be politics in India and so on. So those things are going to drive a decent amount of volatility. So what we are telling our investors in general is that this is a year where you should settle for more moderate returns. And brace for more volatility. And at the same time, I think there's a year in which you can't really drive momentum. You can't really buy things which are really very expensive to begin with and expect that you will be able to sell it off at even higher multiples. So I think as a starting point, either as fund managers buying stocks or an investor buying funds, we have to be a lot more reasonable in terms of what we buy and at a lot more reasonable valuations. That will ensure that we, at one level, protect our downside and also probably leave ourselves more room for being able to generate more returns and alpha.
Tahir, afternoon. I remember our last conversation, which was, I think, early June.
Oh, hi.
You had mentioned that you're still keeping a fairly conservative, neutral sort of a stance on pharma. Since then, we have seen an impressive turnaround in stock prices. It's been the sector of the month of June. What is the reading for you at the moment? Are you looking to buy more pharma stocks, add them in your funds?
So broadly, the view remains the same in the sense that we had a certain amount of footprint in pharma across some of our funds. We have modestly increased the weightage as you would have probably seen over the last 1 or 2 months. The view is basically this, that there were two challenges, of course. One is, of course, the regulatory challenge and then the pricing related challenge. We have seen that more or less the pains around the regulatory challenge are coming to an end. Pricing is partly kind of bottoming out, but we are still not, we are not able to take complete, confidence in the pricing part of the equation, and therefore to that extent we are keeping an incremental approach. We have a footprint can we take an outright call on being significantly overweight on pharma? We have not yet done that, but we have a reasonable presence now. And in funds which allow us that freedom based on the mandate. So, for example, our contra fund is now significantly overweight pharma as well, compared to where we were, let's say, about 3 or 4 months ago. So that's an incremental positioning in pharma as of now.
This year's theme has been capital preservation, and you have done that remarkably well. I'm looking at the top holdings. You have HDFC Bank, IndusInd Bank, Kotak, Reliance, L&T, TCS. At least in the India Growth Fund, and of course, most of these stocks are closer to life highs. You reckon some of these stocks where valuations are at an all-time high could continue to be re-rated from here on as well? Because one view is that overvaluation is as much a risk right now, and just because money is moving from mid caps to large caps, you should just not be loading up to some of these overvalued stocks.
So at least some of the names that you mentioned and a few of these positions that we have right now, while the valuations have moved up and they are, I would of course admit that they are no longer cheap and maybe they are not really inexpensive, but they are also not atrociously priced either, and therefore to that extent we are somewhere in the middle. We have seen some valuation expansion, we are cognizant of that. However, the fundamentals too are kind of reasonable out there, and we see outlook to be better to improving. And therefore, to that extent, I think for now we are okay with that. We are keeping a watch. We are not in a very, very overextended zone in terms of valuations. Maybe they're a little more expensive than their average. And from where we have seen them, let's say, for example, the tech sector, for example, we've seen them at 13, 14, 15p multiple below market valuations, and now they are at premium to market valuation. So some journey has clearly been covered, but not still atrocious enough for us to completely abandon them. So that's to that extent. Therefore, we are, and from that perspective, we need to keep a portfolio balance. So yes, as we also look at some of the beaten down names and some where we can have a cyclical upturn, we also remain well balanced with exposure to companies which continue to be on a reasonable growth path.
Tahir, another interesting sort of holding in one of your funds is, I think, Mahanagar Gas. General question, I know we can't discuss stocks, but just general question, City Gas distribution plays haven't had a great last few months, 6-7 months at least. Even stocks like IGL have kind of fallen off the radar. MGL itself is not yet turning around. What do you think is keeping these stocks from flying off and taking off again? There is this new city gas distribution sort of bids that are going out there, big capex plans, but why aren't the stocks moving, you think?
So I think it's a quite a interesting question that you asked. We were recently within our discussion, quarterly discussions, and this is a sector which came out to have undergone somewhat of a pain across all elements of the oil and gas space, be it the OMCs or be it the gas stocks and the distribution stocks and the utilities, etc. Everything put together. And after this recent sort of underperformance across the sector, some of these names that you mentioned and a few others are turning out to be opportunities in our view. I think it's I don't know, but it's difficult to reconcile. It looks like the oil prices going up has deterred investments in this sector, and investors have been a little cagey. But increasingly, we find that many of these companies do not have any strong linkages to oil prices, barring of course the OMCs in some way. But so to that extent, the valuation correction, some of these franchises still remain reasonably strong, are well positioned for volume growth, and in fact, we are willing to look at it a lot more constructively now, given these valuations that they are available at. So we are a lot more positive on the sector at this stage.
Okay, by the way, there's a big move happening right now in Adani group of stocks. Just pull out Adani Green first. That stock is surging, and Adani Enterprises. Just pull out these two stocks intraday, and there's quite a bit of move that you're seeing right now in Adani group stocks. It happens, of course, in a market like this where high beta makes a bit of a move, but all of a sudden there's a bit of a price volume breakout which has taken place. That's Adani Green, of course, up 11%, and among the largest stocks, Adani Enterprises is making a bit of a move. Tahir, for longest you have liked auto stocks. Of course, Maruti has been your favorite. There was a time when it used to be about more than 20% of your fund. In general, on autos now, they have corrected quite a bit, but the sales numbers still look good. You think that's one area where some value can be found?
Certainly. I mean, that's another one which came up our radar, and we have been positioned there. I think that's looking a lot more constructive. Once again, even a good number of stocks in this pack have corrected for reasons which are a little unfathomable, but clearly they've become opportunities. Numbers, as you said, remain reasonably strong. Even from a macro perspective, we don't really see any great headwinds or challenges for this sector immediately. And of course, now with a little more of the rural tailwind coming about, I think these stocks are making a lot more sense. They had valuations which are reasonably comfortable. So across the spectrum, two-wheelers, some of the agri auto names, some of the car players, everything is starting to look as attractive, and we are well positioned for that. And we are only increasing that even today.
All right, Tahir, good talking to you as always. Thank you very much for taking out the time and sharing those thoughts with us. So that's Tahir Badshah, Invesco